Before performing a deeper financial analysis of Home Depot's financial statements, it is important to understand what makes companies successful. So in this video, we cover the key areas of business performance. We begin by first identifying the key elements of running a successful business by briefly reviewing what we had to do to start our own business. Remember Gone Fishing back in video 7 of this series, entitled Key Areas of Running a Business Gone Fishing? In that story, we had to arrange our financing by attracting $200,000 of equity capital and then $300,000 of debt capital. In doing so, we established our capital structure, $500,000, 40% equity capital, and 60% debt capital. Another term used to describe the extent to which we rely on debt in our capital structure is leverage. Here the capital structure is 60% levered. That is, 60% of the company's financing is comprised of debt. It is called leverage because debt can act like a lever. If the company can use the $300,000 of debt capital to create annual profits, say $30,000, that exceed the annual interest cost of the debt, which in this case is 8% times $300,000 or $24,000, the company will increase bottom line net income, which belongs to the shareholders, by $6,000 without using any of the shareholders' investment. This can significantly boost, like a lever does, the shareholders' return or return on equity, ROE, net income divided by the shareholders' investment. Let's work an example to demonstrate the power of leverage. Suppose a company needs $1 million for a project that is expected to produce an annual return of 10% or $100,000 per year. In scenario 1, assume that the project is financed by issuing stock for $800,000 and borrowing from a bank $200,000 at a 5% annual interest rate. That is, the project is financed via 20% leverage or debt and 80% equity. Assume further that during the year the project creates the expected $100,000 in profit, with a $10,000 interest cost, 5% times $200,000, leading to a net bottom line profit of $90,000 and a return on the $800,000 equity investment of 11.25%. $90,000 of profit divided by the $800,000 equity investment. In scenario 2, let's increase the level of leverage from 20% to 80% and see what happens to the return on equity percentage. Assume here that the company finances the $1 million project with $800,000 of debt and $200,000 of equity, which increases the leverage from 20% to 80%. Again, as expected, the project creates a $100,000 profit, but this time the additional interest cost of $40,000, $800,000 times 5%, leads to a reduced net profit compared to scenario 1, from $90,000 down to $60,000. However, the return on equity calculation jumps from a little over 11% to 30% because the equity investment is much, much lower. In essence, the company used the bank's money to provide a higher return to the shareholders. Yes, profits were reduced, but the ROE almost tripled. Let's now return to our original Gone Fishing illustration with a capital structure of $300,000 debt and $200,000 equity and a leverage rate of 60%. Once this capital structure was established, we then invested the $500,000 cash we raised, $400,000 in producing assets, and $100,000 in operating assets. As we made this investment, we had to keep in mind that the debt or leverage we have in our capital structure creates contractual commitments to make debt service payments in the future, which is what makes leverage risky. The more leverage, the more risk. Consequently, to manage that risk, we had to make sure that Gone Fishing is solvent, meaning that the operations of the business must be able to create sufficient operating assets and ultimately cash to cover the debt payments as they come due. Missing a contractual debt payment can be extremely devastating to a business. The more leverage used in the capital structure, the greater the pressure on the business to ensure it is solvent. These two concepts are closely related. The next issue involves whether the asset investments are generating sufficient revenues. Recall that the definition of assets assumes that they generate revenues in the future. Good assets generate lots of revenues, while poor assets do not. Because assets are used up and eventually replaced in the operation of the business, we use the expression asset turnover to describe how well the assets are generating revenues. Assets that turn over quickly generate more revenues than assets that turn over slowly. Keep in mind, too, that asset turnover and solvency are related. Liquid assets like cash held onto to meet debt obligations do not generate any revenues. So in general, companies that maintain large cash balances while increasing solvency are damaging their asset turnovers. In addition to leverage, solvency, and asset turnover, the fourth major issue involves expense control. Generating lots of revenues is good, but profits depend just as much on whether the expenses are being held in check. Given the level of revenues, every dollar of expense that we save converts to a dollar of profit or net income. Finally, if the company is operating on all cylinders, choosing the proper level of leverage, maintaining solvency sufficient to meet the debt payments as they come due, with assets that turn over quickly and produce lots of revenues and expenses that are well controlled, the goal is achieved, a large net income number. And by large, we mean large compared to the asset investment, which in turn gives rise to a high ROA, return on assets, and large compared to the investment made by the shareholders, which in turn gives rise to a high ROE, return on equity. To summarize, this discussion has identified 4 areas of a company's performance critical to its success: leverage, the level of debt in its capital structure; solvency, the ability to meet its debt obligations as they come due; asset turnover, the ability of the assets to generate revenues; and expense control, the ability to keep down expenses. The extent to which a company is successful in these 4 areas will determine the company's profits and how the level of profits compare to the investment made in assets, return on assets, and the investment made by the shareholders, return on equity. Both are very important measures of a company's success. In the next video, video 27, we identify measures constructed from Home Depot's financial statements designed to help us assess the company's performance in each of these important areas.